Welcome back to Investing Talk Podcast.
Today we're looking at critical metals core.
Yeah.
And honestly, if you've been watching the markets, this is one of those tickers that's just impossible to ignore.
It really is.
We're talking about a volatility play that is sitting right at this explosive intersection of mining, heavy geopolitics, and massive government funding.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really appreciate it, and it helps us keep digging into these complex stories.
So let's get right into it. You mentioned volatility. I mean, we just saw a recent surge of about 17%.
Yeah, in a day.
And that has everyone asking the same question. Is this just a penny stock roller coaster, the kind that's going to make some people rich and others broke?
Right.
Or is this a legitimate strategic asset in the race for non-China rare earth elements?
That is the question, isn't it? Because when you look at the chart, it feels like a roller coaster designed by a madman. But the narrative here is really a clash. It's a clash between terrible, and I mean terrible, current liquidity and this massive promise of future government backing. It's the kind of setup that usually ends in tears or a yacht.
Very little in between.
Exactly.
It's a binary bet.
Yeah.
And to understand why the stakes are so high, you have to understand the specific metal they're hunting. We're not just talking gold or silver here. We are talking about the building blocks of modern warfare and green energy.
The sci-fi stuff.
The sci-fi stuff. But before we get there, we have to look at the checkbook.
Right. So let's unpack this. We have to start with the fundamentals, and going to be honest, looking at the numbers, it's a little scary. It looks like a horror movie for an accountant.
It usually is with pre-production miners.
Mm-hmm.
You have to, put on a different set of glasses to read these balance sheets. You can't look at it like you're analyzing a grocery store.
I tried putting on different glasses. It still looked red. Listen to this. Fiscal year 2025 revenue is sitting at $560,623. That's it.
That's it.
That is the revenue of a decent coffee shop, not a mining conglomerate. Now, yes, that is up 376% year over year, which sounds great as a percentage.
But the base is tiny.
It's microscopic for a public company.
It is small, I'll grant you that. But remember, they aren't selling the metal yet. That revenue is likely just incidental.
Sure, but here is the kicker. The net income is a negative $51.7 million. They have an EPS of negative 56 cents.
Oof.
I have to ask, how does a company losing this much money actually survive? We are talking about a cash burn that seems completely unsustainable.
It looks bad on paper if you're analyzing it like a mature tech company or a retailer like Walmart.
Yeah.
But you have to shift the lens. This is the pre-production reality.
Okay.
You aren't buying current cash flow here. You are buying the ground. You are buying the potential of what is in the ground. And if you look closer, they're making moves that signal they are serious about scaling, not just burning cash for fun.
Giving an example of a serious move then, because burning $50 million is a lot of heat.
Well, for instance, they just invested in a new $1 million mobile geochemical analysis center.
A mobile lab, so they can drive the science right to the rocks.
Exactly. I mean, think about the logistics of mining in remote locations. Usually, you drill a core sample, you pack it up, deal with customs, ship it to a third-party lab in another country.
And wait.
And you wait 3 weeks for the results to tell you if you drilled in the right spot. It's agonizingly slow.
And time is money, especially out there.
Precisely. With a mobile lab, you get data on site in real time. You drill, you analyze, you adjust. It increases operational efficiency so much, it's a signal that they are gearing up for speed.
Okay, that makes sense operationally. Speed is money, and waiting weeks for results in the Arctic Circle sounds like a nightmare. But let's look at that balance sheet again, because you can have the best lab in the world, but if you go broke, it doesn't matter.
Right. And here's where it gets interesting. They have about $171 million in total assets versus only $79 million in liabilities.
So the leverage isn't actually that bad.
Not at all.
But are those assets liquid? I mean, can they sell them tomorrow to pay debts? Or is it just the estimated value of the land?
A lot of it is the asset value, yes. But that is the competitive moat. That is the China-free premium we talk about.
Mm-hmm.
You have the Tanbreez project in Greenland. This isn't just a random plot of ice. It's showing ultra-high-grade results.
Right.
And you have Wolfsberg in Austria, which just recently renewed its license.
Austria seems like a much safer bet than Greenland in terms of infrastructure. I imagine the roads are better.
Much safer and fully permitted. These are assets located in friendly jurisdictions. That is the moat. You can't just replicate a mine in Greenland overnight, China controls the vast majority of rare earth processing. So finding a deposit of this quality outside of Chinese influence it's like finding a needle in a haystack, but the needle is made of dysprosium.
That is true. But assets in the ground don't pay the electric bill today. What is the lifeline? How do they keep the lights on until that dirt turns into money? Because that negative 50 million net income isn't going to fix itself.
That is the $120 million question, literally. They have secured $120 million in non-dilutive funding from the U.S. Ex-Im Bank.
Okay, we need to pause on that. Non-dilutive. That is the magic word for shareholders, right? Can you explain to everyone listening why that specific phrase matters so much?
It is everything. Usually, a miner this size needs cash to survive. So what do? They issue more shares.
They sell more stock.
They sell more stock to the public. And when they do that, your piece of the pie gets smaller. Your shares are worth less because there are more of them. That's dilution.
It's like watering down the soup. Eventually, it just tastes like water.
Exactly. Non-dilutive means they got the money backed by the U.S. government without selling off more equity. It prevents that shareholder dilution.
And that's rare for a company this size.
Incredibly rare. It signals that the U.S. government sees them as a strategic necessity. They are effectively saying, we need this mine to work for national security. Plus, you have the joint ventures, specifically the connection to Saudi Arabia for processing. They aren't going it alone.
So the government creates a floor, essentially. They are putting a safety net under the tightrope walker.
In a way, yes. It validates the asset quality. The Ex-Im Bank doesn't just hand out $120 million checks without doing some serious due diligence. They check the geology, they check the management, and they wrote the check.
All right, that's the fundamental picture. Bleeding hash today, but sitting on a gold mine, or rather, a rare earth mine backed by Uncle Sam. Now let's pivot to the charts. Because if the fundamentals are a long-term play, the technicals are a right-now art attack.
It has been wild. If you are prone to motion sickness, do not look at the daily chart.
Wild is an understatement. We are looking at a 52-week range that spans from $1.23 all the way up to $32.15.
It's nuts.
That is not normal volatility. That is crypto-level volatility. That is Dogecoin in 2021 energy. Recently, we've seen highs around 1514, with intraday swings testing that mid-teen resistance. It's all over the place.
It is. But look at the trend underneath all that noise. The stock recently broke above its 50-day moving average, which is sitting at 1175.
Okay.
That's a classic momentum signal. When you cross that 50-day line, algos and technical traders, they start to pay attention. It flips the switch from downtrend to potential reversal.
But what about volume? I saw a massive spike on February 10th. It went up to 6.23 million shares traded, but that was during a downside move. Usually, high volume on a down day is a sign of people rushing for the exits. It looks like a fire sale.
You would think so, and that's the trap retail traders fall into. You have to look at who is doing the trading. This is where we separate the dumb money from the smart money. Look at the options flow. The put-call ratio is 0.39.
0.39. That is extremely low.
It's incredibly bullish. For those who don't trade options, the put is a bet the price will drop, and the call is a bet it will rise. A ratio of 0.39 means for every put option, there are vastly more call options. People are overwhelmingly betting on the upside.
So the people putting real money on the line.
The people putting real leverage on the table think this is going higher.
So the sentiment in the derivatives market is positive. What about the big boys, the institutions? Because usually penny stocks or volatile miners are retail playgrounds.
This is the most shocking part of the data. Institutional ownership has risen to 86.44%.
Wait, 86% of the company is held by institutions? That leaves almost nothing for the public float.
Yes, and that number is climbing. We've seen a 42% increase in the number of funds holding the stock. We're talking about 135 different funds now involved. Major players like AQR, who are quantitative giants, are increasing their stakes.
That is a stark contrast to the retail sentiment I see on message boards where people are terrified of the swings.
Exactly. Retail sees a 10% drop and panics. They sell. Institutions see a 10% drop and see a discount. They are loading up because they're looking at that 2026 horizon, not tomorrow's closing bell.
So the argument is that they're shaking the tree.
They are shaking the tree to get the weak hands to let go so they can scoop up the fruit. The big money is using the volatility to accumulate shares.
That is a fascinating disconnect. Let's bridge that into the market mood. What is the broader sentiment driving this? Because a stock like this doesn't move in a vacuum. Why now?
No, it doesn't. And right now, the quantitative sentiment is flashing bullish. It's green across the board.
What are the headlines driving that? Is it just the general EVs are the future narrative, or is there something more specific? Because that EV story has cooled off a bit lately.
It's much more specific. First, you have Project Volt.
Project Vault. That sounds like a spy movie. Or a Marvel villain plot.
It does, doesn't it? But it's actually the Trump administration's plan for a $12 billion stockpile for critical minerals.
$12 billion.
When the government announces a $12 billion shopping list, and you are one of the few shops in town selling what they need, that drives hype.
And Critical Metals is positioned for that.
Perfectly. Especially with the Tanbreez results. We just got final assay results showing up to 27% heavy rare earth elements, or HREs.
Okay, stop there. Heavy rare earths. Why does that distinction matter? I assume all rare earths are rare. Why is heavy better than light? Is it just the weight?
Great question. It comes out of physics and geology. Light rare earths like cerium and lanthanum are actually relatively common. You can find them in a lot of places. They're used in, polishing glass, catalytic converters, things like that.
Okay, so useful but not super rare.
Right. Heavy rare earths, things like dysprosium and terbium, are much, much scarcer.
Yeah.
But here is the catch. They are absolutely critical for high-performance magnets.
Magnets.
If you want a magnet to work at high temperatures, like in a jet fighter engine, a wind turbine offshore, or high-performance EV motor, you need the heavy stuff. Without it, the magnets demagnetize when they get hot.
And I assume a demagnetized fighter jet engine is a bad thing.
A very bad thing. China dominates the heavy rare earth market even more than the lights. They have a stranglehold on it. So a non-China source of heavy rare earths, that demands a massive premium. It's not just a commodity, it's a geopolitical asset.
I see. So it's not just rare earth, it's the rare earths. It's the premium unleaded.
Exactly. And then you add the Wolfsberg update, they got a 2-year license extension. That removes a major regulatory risk. The market loves certainty, and that license renewal provided it.
Even with all that, I'm the skeptic here. I see analysts moving targets up, but analysts are wrong all the time. I see a price target hike to $20.40, which is a potential 34% upside, and a strong buy rating at $12. But is the market getting ahead of itself?
That's always the risk.
Yeah.
But there's also the rumor mill to consider. We are hearing speculative buzz around a $20 million acquisition of a copper powder stockpile.
Copper powder? That seems random. Why copper?
It's specifically for defense and aerospace angles, a diversification play. Copper powder is used in high-tech manufacturing, 3D printing for aerospace parts, that sort of thing. It aligns with the critical metals branding.
Okay.
And there are unconfirmed rumors about the Saudi joint venture offtake agreements. If those get confirmed, if we see a headline that says, Saudi Arabia agrees to buy X amount of product, that $20 price target might actually look conservative.
Okay, rumors are fun and $20 targets are exciting, but let's bring everyone back down to earth. I need to put my skeptic hat back on firmly. We have to talk about the risks. Because for all this glory, there are some flashing red lights on the dashboard.
It wouldn't be a proper analysis if we didn't look at the bear case.
Right. So let's talk about the liquidity crisis. I mentioned the cash burn earlier, but let's look at the ratios. The current ratio and quick ratio are sitting at a terrifying 0.13.
That is tight.
Tight. That is suffocation. For the listeners, a ratio of 1.0 means you break even on your short-term debts. A ratio of 0.13 signals imminent bankruptcy for a normal operating company. It means for every dollar of debt due soon, they have 13 cents.
You are absolutely right. If this were a shoe store or a software company, they would be filing for Chapter 11 tomorrow. There is no spinning that number as good.
And their debt to equity is 0.16. It feels like they are walking on a razor's edge.
It is a valid concern. If they weren't sitting on that government funding line, this would be a sell immediately. The bear case is simply that they run out of runway before the plane takes off.
Right.
They could get tangled in bureaucracy, accessing that exit money, or they could burn through it faster than expected.
And it's not just the company, it's the market. The broader rare earth market has been trading lower recently. Commodity prices are facing headwinds. If the price of the metal drops, the value of the dirt drops.
That is true. It pressures the stock regardless of company-specific news. A rising tide lifts all boats, but a falling tide grounds them. If the global price of dysprosium crashes, Critical Metals Corp feels the pain.
And I noticed that not everyone is drinking the Kool-Aid. There is analyst divergence. We have those aggressive price targets, but there are also sell ratings out there. Weiss and market beat consensus have shown sell signals, so the smart money isn't unanimous.
There absolutely is. And the biggest risk, in my opinion, is simply execution risk. There is a massive gap between drilling success and actual production. They are targeting 2026 for production.
2026? That's 2 years.
A lot can go wrong in 2 years. Delays, technical issue, geopolitical shifts. Mining is hard. The weather in Greenland is unforgiving. You have a short season to work. It's a long, hard road from a drill hole to a revenue check.
Right. It's one thing to find the metal. It's another thing entirely to get it out of the ground, process it, and sell it at a profit. 2026 feels like tomorrow in mining years, but for an investor watching that liquidity ratio, it feels like a decade.
That is the tension. You have to survive the valley of death to get to the mountain of gold.
So we have the massive potential, the government backing, the scary balance sheet, and the volatility. It is time for the verdict. Based on all this, the charts, the fundamentals, what is the score?
When I weigh everything, the risks against the sheer strategic value of these assets, I am giving this a bullish score of 8 out of 10.
8 out of 10, even with that liquidity ratio of 0.13, that is bold.
Yes. Here is the thesis. This is a multi-year hold into 2026. You cannot trade this day to day unless you have a stomach of steel. But the combination of high-grade assets, specifically Tanbreez and Wolfsberg, and that China-free geopolitical premium is unique.
And then you add the government backing.
Then you add the massive government backing, the $120 million from XCM and the alignment with Project Vault. It just changes the calculus. It outweighs the terrifyingly low current liquidity because of the government effectively puts a safety net under them.
So the thesis is basically, the asset is too strategic to be allowed to go bankrupt.
Precisely. The U.S. government cannot afford to let this fail. They have identified this as critical infrastructure. If the U.S. wants to decouple from China on defense supply chains, they need mines like Tanbreez to work. They don't have a plan B.
Okay. So for the listener who's interested, what should they be watching? What are the catalysts?
Watch the earnings date on March 18th, 2026. We need to hear updates on the timeline. And keep an eye out for further Tanbreez drilling follow-ups. We need to confirm those high grades extend across the deposit.
And that March date is crucial. If they miss deadlines or if they burn cash faster than expected, that bull case could crumble fast.
Agreed. But for now, the final call is that while volatility will remain high, the institutional accumulation suggests the bottom is likely in. The big money has placed its bets, and they're betting on the West needing these metals badly.
Well, there you have it. A high-risk, high-reward play backed by the heavy hand of geopolitics. Certainly not boring.
Definitely not.
That brings us to the end of this breakdown. If you enjoyed this and want us to cover more strategic assets like this, please make sure to subscribe to the channel.
And let us know in the comments, would you hold through the volatility for that 2026 payoff? We want to hear your take.
Thanks for listening, and we'll catch you on the next one.